Good afternoon, everyone. Welcome to the ET Markets webinar on the state of the Indian economy. While macro data shows things are looking up on the domestic economy, the ground reality seems to be quite different. Do these numbers tell the real story? Are we really growing? Will the economy deliver in FY17? What are the risks ahead? These are some questions haunting the Dalal Street these days. In today's ET Market webinar, we have Mr. Subhadeep Rakshit from Kotak Institutional Equities to decode the bare numbers, give us a reality check of the economy, and tell us where we are headed. A very warm welcome to you, sir. We have a large audience waiting for you. Mr. Rakshit will now make his presentation, which will be followed by a question and answer session. I would request all of you participating in the session to keep posting your questions in the small chat room on the right side of your screen. We usually get a lot of questions, so the faster you post your questions, the better chances are for them being answered by our expert. So here we go, the presentation first. Over to you, Mr. Rakshit.
Thank you, Ankur, and good afternoon to everyone. Before I start off, let me just kind of talk about what I will be sharing with you over the next 20-25 minutes. Broadly, the presentation will be divided into three sections. First, do a quick status check, where the economy is, what the indicators are talking about, what are the fundamentals talking about. Second, move on to some of the key themes that might play out this year in the Indian economy, and quickly wrap up with some of the conclusions, some of the key takeaways for FY17. To start off, one key thing that we should be looking at in terms of, while we look at an economy, is break it up into 3-4 main fundamentals and talk about, say, for example, the way I do it is look at the external sector, which is the CAD, the current account deficit, the current capital account flows, etc. Look at inflation, which is basically the price pressures in the economy. Look at the fiscal, and by fiscal I mean the center and the state taken together, though the center usually is the more important part in the fiscal space in terms of taxation, in terms of expenditure, the quality of expenditure, the borrowing of the government, which ultimately leads to what the market interest rates might be. And lastly, all these feeding into, in some sense, the GDP growth, or how much output are we producing, or what is our demand story like. So if you look at, and over the last, say, 2 to 3 years, specifically starting from May 2013, a quick status check would reveal that, how have we progressed over the years in terms of the various fundamentals. If you look at, say, starting May 2013, the first indicator or the first metric that started improving was the current account deficit. Now, that typically shows that, in terms of, the resilience to external sector shocks, we are starting to become, or we are by now much more immune, or much stronger to at least safeguard us from the external volatility. Next came in around 2015 onwards, the inflation bit, where the retail price inflation started to moderate and moved on closer to where the RBI and the government is comfortable keeping the inflation at, so closer to around, say, 6%, progressively to a 5%, and probably through FY17, FY18 move closer to a 4%. We'll come to that, and we'll discuss all these metrics in a little more details in some time. Fiscal consolidation, if you look at the center, it has actually from last year or probably a year ago, they have been pretty strict on how they want to look at the fiscal consolidation. They have been on the path, fiscal consolidation path. They have taken care that expenditure quality is not compromised on. So broadly, what they are looking at is trending towards a 3% by FY18, FY17 target being at 3.5% as outlined in the last budget. The states, on the other hand, obviously there are some issues in terms of how you want to read the state budgets, given that a lot of the states are now incorporating the power bonds in their fiscal deficits, though they won't be a part of the fiscal deficit calculation towards the FRBM targets, which is basically, a statutory limit that the states can have, or each of the states can have, either a 3 or a 3.5%, depending on which state we are looking at. So broadly, the aim is to cap the state budget deficit as an aggregate to GDP to around 3%, or closer to around 3.2%. Till now, what we are kind of looking at in terms of numbers is that possibly, excluding how the power bonds evolve and how much, without taking into account the power bonds, will probably be closer to a 3% over the next 3-4 years. And ultimately, coming back to the main theme of the presentation in some sense, or at least trying to answer, where do we stand in terms of growth? So in terms of growth, we have a lot of numbers that are given out, and say, for example, real GVA that we generally track as a metric for the output. FY16 predicted to be around 7.3, 7.4. We look at the FY17 slightly higher, 7.7. But there are certain caveats in that. We'll come to that when we discuss these numbers a little later. So this is the status of the economy. 2014 onwards, each of the metrics individually have started improving. Growth is the question, and which probably is the theme of my presentation in terms of talking about a slow recovery, and a long road to recovery. So we will discuss some of these points in further details. But having said that, all these are possible and possibly, dependent on two sources, two pillars, as I put it. One is the RBI, which broadly has, 5 main objectives to fulfill in terms of macro prudential, in terms of having a safe macroeconomic environment. So they talk about monetary policy, financial market depth, banking sector expansion, financial inclusion, distress management, which is again, talking about the NPAs, etc. So each of these objectives, we have made significant progress in each of these, which obviously, makes the RBI one of the more proactive and, in some sense, better central bank, which has been dealing with a lot of challenges. And the RBI has been at the forefront, and that obviously has been, visible in terms of how the NPA recognitions have happened, how the inflation trajectory itself has moved. So, and along with the RBI, there's obviously the government, where the government has been very clear in how it wants to outline and how it wants to go about the reforms process, which obviously goes hand in hand with what the RBI is trying to do. The way we look at the reforms process is break it up into 4 main parts. One is fiscal, investment, banking sector, and the governance. When we talk about fiscal, and as you can see on your screen, that there are, we talk about the GST, DBT, subsidies, etc., that fall under the fiscal, and most of them are already in progress. Most of them will be coming into implementation very soon, or some of them have already been implemented. For example, the DBT scheme, which is for LPG, already implemented. On the investment side, we talk about, or the government, as they put it, talk about land reforms, labor reforms, pricing of factors of production. So, for example, it could be oil and gas, coal, power, etc., a market price for that. Auctioning of natural resources, and taxation, which is one of the key elements in terms of either for the corporates or the FIIs. In all of these, again, except for very clearly, say, land and labor reform, the center has been proactive. They have, for example, if you look at the market pricing mechanism, if you look at the auctioning of natural resources, they have been pretty much on track, or at least legislations, etc., have been put in place. Fewer auctions have also happened. But clearly, for reforms like the land and labor reforms, they have been passed on in some sense to the states, because anyways they are state subjects, and hence it's best that they deal with it. So from that perspective, again, investment is kind of the weak link in the kind of reforms process, because land and labor reforms are the key impediments in some sense to an investment cycle, and that has been pushed on to the states, which obviously, if you look at Rajasthan, if you look at Haryana, etc., they have been very proactive in kind of talking about or passing legislation in at least in the land reforms, and to some extent the labor reforms too. The banking sector, obviously, in hand with the RBI, the government has pushed for a financial inclusion plan, has pushed for a recognition of NPLs, has pushed on for restructuring of how PSU heads are appointed, and so in all, it's been a very good progress in some sense. Whether it's translating into results, that might be debatable in some sense in terms of financial inclusion, etc. But the progress is visible. What the final result will be, we'll come to see, because there are a lot of moving parts when it comes to some of these reforms. They are interconnected in some sense, so the ultimate result might not be as we expect, but obviously the progress is there in terms of at least moving towards that goal. And governance, obviously, in terms of the black money being curbed, obviously a lot of talks have been on. Restructuring or reducing bureaucracy, making bureaucracy very streamlined, judiciary reform, these are all again work in progress, but kind of moving on in some sense. Though I think on the governance part, it's important to mention that governance through, say, the e-governance kind of a platform, that has been very, very significantly visible from these from the current government, and they have been pushing for that. Moving on to at least giving a snapshot of how the economy is doing, and I'll just have a couple of slides on that. This is, in some sense, the activity indicators, looking at, say, the industrial space, the services sector, and the demand conditions. When we look at key indicators like a credit growth, IIP, consumption of fuel, steel production, tourism, and passenger vehicle sales, auto sales, etc. India is not doing that bad in the sense that the mood that had been, say, around 3 to 6 months back. Obviously, the mood is starting to change. We are looking, at least the numbers speak for themselves. We look at, say, specifically auto sales, they have been pretty strong, at least on the commercial vehicle side. Petroleum consumption, to a certain extent, fuel consumption overall has been pretty strong. IIP, again, the index itself has questions, doubts regarding. Experts raise doubts, but at least stabilizing is what I would put it at. And if you look at credit growth, obviously the bulk of the credit growth has been towards the personal loans, because the banks have been pushing for retail loans rather than the corporate, because anyways the industry has been very lackluster over the last few years. So in terms of the retail demand, obviously we are seeing some of it through the credit side. And if you look at some of the business indicators in terms of the PMI, etc., they seem to have kind of stabilized and continue to be broadly sideways. But so obviously the takeaway that we have from all these indicators is that it's very early signs of the recovery process. It's not as if recovery is on a very strong footing. It's very nascent, and there are certain elements which need to come in. For example, private sector investments, which will actually push forward the investments, the economic recovery on a more strong footing. Wrapping up the current status in some sense, or some outlook on the interest rate and the currency. Obviously, we are, the RBI has already moved 150 bips. Another room for 25 bips is what we factor in. This is again basically factoring in that inflation can trend down towards a more steady 5% and stay lower or around that mark, which will give some amount of room from the current 650 of repo rate, 6.5% of repo rate, to a more 6.25%. So I think it's from an interest rate perspective, we've seen much of move from the RBI happening. I think there is a fair bit of translation on the bank side still left. They have not passed on entirely. We'll possibly see that as and when the bank's balance sheet positions improve, liquidity improves, which the RBI wants to bring down to a neutral level from the current deficit mode, which will help in transmission of the monetary policy rates. On the currency side, obviously, talking about the currency and the strength of the currency brings us first to the FX reserves point, which is the top left-hand side chart that you would see. $360 billion of FX reserves that the RBI has currently, which is actually at a much stronger level than we had seen in May 2013. And I keep going back to May 2013 because that was probably the trough of what the Indian economy was at in the recent past. And from there on, we have built a significant amount of strength in terms of the external sector vulnerability. On a currency perspective, if you're looking at a kind of competitiveness, if you're looking at some kind of talking about the normal argument of export competitiveness due to depreciation, etc. If you look at the top right-hand side chart that talks about the real effective exchange rate, that still shows around a 4 to 5% overvaluation, and this is on a 36 country comparison, which means that amongst peers or trading partners, India is still overvalued even after depreciating because either due to one inflation, comparative inflation, relative prices, or due to the other currencies depreciating much more than what India has. So from that perspective, if we were to give out forecasts, and this, it's currency forecasts are a very tricky estimation procedure. I mean, it's almost like a shot in the dark, probably, as is most of the market variables. But at least if we had to put out some kind of an estimate, we are happy with a range of around 66 to 69 in the near term. There are risks that the rupee might touch a 72, 72 kind of a range, but that is kind of factoring in a significant amount of dollar strengthening, a significant amount of yuan or a China-based weakness coming in. So from that perspective, I think we factor in a 66 to 69 range in the near term, and we would stick to that. In terms of themes, three themes that we are playing out is resilience to global shocks, growth recovery, which is likely drawn out, and structural drivers which are starting to improve again. So if I were to look at the fundamentals, if I were to look at the resilience to global shocks, which typically means that the fundamentals of the economy have improved and look at a much solid footing than it was. Obviously, inflation has started to trend down. I think there are fundamentals which support that fact also. For example, inflation expectations have started to get more anchored towards a single digit or a very low double digit number. Rural wage growth has been capped significantly, which is one of the biggest drivers of retail inflation. That also has to do with the rural demand has been weak, which is reflective in your rural GDP also, which obviously has helped in certain sense, but not the most beneficial point, but has helped to a great extent in capping CPI inflation. Looking forward to FY17, obviously the monsoons probably will be much stronger than what we have seen over the last couple of years, and that should help in two ways. One, keeping a cap on the inflationary pressures from the food prices side, and second, probably again regenerating some amount of rural demand which has been missing. And the gains from output prices that the farmers are producing. So from that perspective, I think the monsoons turning above normal or normal from this year should help, and I think it's high time that happens, because otherwise we'll have another weak monsoon, weak growth cycle, and possibly again inflationary pressures coming in, with the government again comparable to last year. What they did was I think a very good effort in keeping price pressures low. Again, the government has to come in. So from the government's point of view, again, this the chart they exhibit might seem very heavy, but clearly a couple of things that we need to look at is in terms of the risk, rather than because 3.5 is what the government aims to cap it at, the gross fiscal deficit to GDP. What essentially we should be looking at is in where the risks are. One clear risk that we always run, and this is a perennial problem with the Indian the government in general, is that we slip on our divestment targets. So, for example, if we were looking at 700 billion of divestment in FY16, we could manage only 253 billion. Similarly, we have a decently high target for FY17, which again, might seem it's high. Let's put it at that. And the divestment plan, the divestment progress has to be monitored closely, which obviously till now there has not been much of an announcement in how they want to progress through the year. There are certain upsides that can come in terms of the excise duty and the service tax that might come in due to oil-related in terms of the excise duty, oil-related gains that might come in. The other risk, obviously, is in from the expenditure side. And expenditure side, a point to note that the government, and irrespective of which government it is, has been a mover at the very end of the year, where they try and balance the fiscal and keep it at a certain budgeted number, where the capital expenditure is usually reduced. Last year was an exception, whereas an FY16 was an exception, where the government actually spent whatever they had targeted to, without resorting to much of reductions. And from that perspective, I think they have the fiscal consolidation path seems to be on a surer footing, and this is what the capital expenditure, the capital expenditure of the government looks like. Most of it they want to achieve through market borrowing, rather than spending their own resources, which they anyways have to spend due to the 7th pay commission and the OROC related payouts. So from that perspective, I think the fiscal position as of now looks good, but what the progress and the slippages that might come in obviously comes in mostly in the second half of the year. External sector, very comfortable. I think we have the least of the worries, at least for now, till the global commodity prices remain low, till crude prices do not reach back to around the 60 kind of a level. I think we are very comfortable. Current account deficit to GDP, this particular number, which was in FY13 around 4.8%, we are comfortable with this CAD to GDP number reaching around 2.5%. I think India can easily finance that kind of a current account deficit through the capital account deficit. Risk, one of the risks, and this is important to note, it's not a very large risk in terms of value, but from a theme perspective, it's important to note in terms of the remittances, because the oil-producing countries are starting to slow down, or in some sense starting to cut back. And if you are cutting back, then obviously if there are job losses, it's mostly the Indian population that has settled there in the Middle East countries, mostly the blue-collar workers, who are the main people sending the remittances back to India. That could be under some threat. So from that perspective, I think some amount of cautiousness should be built in. Export and import, the story remains the same, that until unless the world grows, it is very difficult for India to grow. It is very difficult for India to export in excess of what the world produces, because anyways India is a very small player, and India lacks competitiveness in terms of manufacturing to really compete with the and find a place in the global value chains as of now. So it will take time, the export part, but on the imports again, it's shielded. One, demand conditions domestically, even though it's pretty stable, is not at its peak, and hence imported consumption is low. Secondly, prices in terms of the crude and global commodity prices are low, which helps in capping the imports at a particular, at a comfortable level. So I think the trade deficit that we are looking at, seems to be on a more comfortable footing, and that is important to note. Even having said that, the export part from a long-term perspective and from a theme perspective should be kept in mind that India needs to push up the the efficiency and the productivity and gain competitiveness through that, rather than expecting that competitiveness will come in through the currency bit. In terms of recovery, what we are looking at, obviously, that this is the most important part. Private sector investment needs to come in. Currently, obviously not possible, given that there is a fair bit of debt overhang, which is visible through the corporate balance sheet being stressed, the bank balance sheet being stressed, and from that perspective, the private sector investment will take time to pick up. And until and unless, and this has been seen through the past decades, that if the private sector investment does not come in, it is very difficult for the government alone to provide or kind of continue with the investment cycle process. And from that perspective, I think it's important to know that this needs to come back, and for this to come back, it will take time, because the balance sheet needs to be cleaned up, the corporates need to be in a better position, there needs to be enough demand visibility for the investment cycle to pick up again. And this again will be drawn out, and hence reflective of growth being in some sense drawn out, not an immediate recovery in terms of the overall growth numbers. So have the private sector obviously missing, but this is what we would I was talking about in terms of the government continuing to put in money, but how long can they put in, or how long can the market absorb the government putting in money in the capital through capital expenditure, is also something that we'll have to wait and watch. And for that reason, the whole investment cycle is possibly dependent right now on the government, but has to shift to the private sector eventually if we are to see any durable and steady and high growth rate for few years, that from FY17 onwards probably. Structural drivers, and this is the last bit that I will spend some time on, is that savings rate, which is important for eventually the investment rate structurally to go up in the economy, will probably start to improve. Clamping down on, say, the black money, etc., has some effect on gold and other physical assets that the households put money into, and hence probably that amount will, in some sense, channelize into financial savings of some sort, and probably help in the investment rate. Overall, and flowing out of all our arguments on the investment cycle, on the external sector, inflation, etc., we come to a standpoint, come to the last bit in terms of the growth, where we are talking about 7.7% in FY17, and around contributed mostly by upside, and here I talk about the delta from, or the change from FY16 to FY17. The most significant change we'll see is possibly in the agriculture, with I think the 2.5% number that I have might be, and if the monsoons really play out, and to that extent, there will be risks on the industrial side and on the services side. Obviously, the GDP numbers in themselves are kind of, people are skeptical about what to believe and what not to believe, old series, new series. But I think it's safe to talk about that these numbers are not out of thin air kind of numbers. They obviously have a base. If you go back to really digging the numbers, if you look at the Ministry of Corporate Affairs database, these numbers corroborate in some sense and talk to each other. So I think it's safe to for now assume that the GDP growth is around 7%, give or take few basis points here and there. FY17 will be pushed through mostly to agriculture, manufacturing, etc. The growth rate being pushed through that is minimal in the sense that the investment cycle, till it returns, it's very difficult to really talk about manufacturing or construction being drivers of growth and taking over from very transient drivers like agriculture. Services, obviously, India has a population which can really put in the demand, and it's visible in terms of urban demand continuing to be strong. Rural demand obviously is weak. So your private consumption, if you really look at the bottom exhibit, has seen ups and downs, but probably will be over the next few quarters continue to remain stable around the 5-6% mark. And that is important to note because that one is one of the biggest drivers that is still holding up. Gross fixed capital formation, which is your investment part, is obviously volatile, and export and import and net export, India being a net trade deficit country, obviously doesn't help our cause in contributing to the GDP part. Important to note, and this is the last point on growth, is that the stalled project seems to have come down over the last few couple of years, and I think that is an encouraging sign. More so because this will be the first step towards the investment cycle recovery, that the stalled projects start to come down, the new project starts to pick up, and some kind of stabilization happens in the investment cycle. I think I'll end the presentation here and just keep this slide on for for the audience and take questions.
Thank you, Mr. Rakshit. That was a very, very enlightening presentation. Many of our participants have already posted a whole lot of questions. Sure. So I'll begin with the first question. In one of your slides, you'd mentioned agriculture will be the biggest driver going forward. So we have Mr. Gautam Shah. He says, how much of the economy do you think is really dependent on monsoons? Can we not do something to avoid our dependence on the rains, and what is the government really doing to overcome the problem?
Okay, thank you for the question. I think it's a very important question, especially as we continue to monitor news where water scarcity is one of the important challenges that the country is facing, amongst others. When I say that it will be the biggest driver, let me clarify what I mean by biggest driver. Is that from FY16 to FY17, if I'm looking at any kind of change in the growth rates per se, let me go back to that slide. If I look at 1.1% being the agricultural growth, if I see the change that of 1.1 moving to 2.5%, that is what I'm saying is driving in some sense or pushing up growth numbers or the growth levels. So I'm not saying that agriculture is the driver of growth in this scenario. Obviously, there are certain sectors. The services sector, for example, is pretty strong, so that obviously is a bigger driver. Agriculture in the whole of GDP forms around 20% or so in terms of weightage. So it is in some sense like kind of to give comparison, 20% of output or the GDP of the country, and it employs 50% of the population or the working population. So that is the broad number that we are talking about. So if the monsoon fails, it's not as if your GDP will immediately go for a toss, but what will mean that 50% of the working population will be under stress. And that is reflected, again, in some sense on demand, and more so on the subsistence level farming that some of these farmers are engaged in. That's where, and without really pointing any fingers, if you look at, farmers' suicide, etc., these are fringe elements which obviously, affect the economy not directly, But overall, when you are employing 50% of the working population, it will be some stress. So the monsoons are important. Second part of the question, that whether we can overcome the monsoon, obviously we can into a great extent if we had focused approach towards irrigation. The irrigation again is mostly a state subject. And irrigation, if you really, and this is some number that I remember, and uh, excuse me if I don't remember it, exact number, but something around the 6 to 7 trillion has been spent over the last 8 years by the states through their state budgets, and the net addition to the irrigation sources, or the net addition to the irrigated area, has been absolutely insignificant. So there is in some sense, a gap between what we are spending and what the ultimate result is. And that is to show that we probably have to do more on the implementation part rather than just spending money. So if you have to overcome monsoons in some sense, you need to have a couple of things in place. One is irrigation. You need to have cold storages or some warehouses which are better managed than what the current structure is, and to a certain extent also improve the yield or the productivity of the land. I mean, you cannot do with traditional inputs in certain sense. Mechanization of land, land parcels, mostly the farming land is very small parcels of land, most of it. And if you do not have Congress land, it's often it's impossible to have kind of mechanized farming coming in. So there are various things that can be done, but the important point to note is that you know we are probably talking to people things. We are still not there. We are still not there. We are still dependent on monsoon, and we will continue to really get worried if monsoons fail. So yeah.
All right. So the next question is from Mr. Murugan Kopuswamy. He says, what are the key parameters to look at for growth signs in the economy?
Okay. I think I had a slide on that. Let me just go back to the slide, and I'll stop on this slide, and uh, you can take a look at the slide. I've kind of segregated into industry, services, and demand. These are some of the key inputs that go in, and in some sense, some of the key inputs and some of the output that we see in the economy. These are the typical sources that you should be looking at from a very, a very, if I were a layman looking at these numbers, I would be looking specifically, say, for example, if I would be looking at cement production, I'd be looking at steel production, I'd be looking at credit growth, fuel consumption, and auto sales. To keep it very simple, these are some of the indicators that you should be looking out for, and obviously looking at it with some caveats in terms of whether it's a seasonal effect or whether there are some there are any particular uh, outliers in some of these data. But overall, from a 6 month to 1 year period, these are some of the indicators that you can actually look at and really get some sense of where the economy is heading. Having said that, this does not encompass everything, and these are only lead indicators or activity indicators in certain sense. The ultimate growth and demand might be a little different, given that there are other sectors also involved.
All right. I hope that answers Mr. Kupuswamy's question. The next question is from Mr. Vineet Chaudhary. He says, do you think the spike in growth numbers has been mainly because of the change in the base year?
Little more complicated. Let me try and simplify it a bit. It's something that we all are kind of grappling with. Base year, definitely, yes. But the bigger changes are, the following points. One, previously you used to have indicators like IIP or Annual Survey of Industries, which would take, which were not the most accurate data. It was at the factory level data that whatever output is being produced is reflected in your GDP numbers. If you look at the current methodology, it takes into account the corporate balance sheets in the sense that they talk about value addition. Say, for example, EBIT, salaries, etc., that they take up at the enterprise level and not necessarily at the factory level. That creates a bit of value addition, a bit of efficiency gains that might come in from the factory gate to the ultimate the balance sheet level, which is being taken care of in the current series. Added to that, the number of companies that were previously looked into has increased. So just to give a sense of the magnitude, is that previously it was something around, if I remember correctly, around 3,000, 4,000 companies that were surveyed or inputs were taken from. Currently, it's almost around 3 lakh companies that the data is collected from. So in a certain sense, the methodology has changed. We have shifted base years, obviously, but more importantly, I think the database or the universe has expanded to take into account a lot more other sectors, a lot not sectors, a lot more the companies, which previously we might have been missing out.
All right. The next question is from Mr. Anshul Sharma. He says, I think the Indian economy is doing good irrespective of weak global economic growth, but we are far behind many powers, and the only solution to this is more infrastructure development. Do you agree to it?
Absolutely, I think. When the gentleman says power, I assume he means the countries. The
Yeah.
power in certain sense. Okay. So yes, I mean, just to keep things in comparison, I think it's important to recognize that India, when compared to its peers, even in the current context, is in a far better position in the emerging market space if we take, for example. Even in the, compared to the advanced economies, how they are progressing, India seems to be in a much stable position. So one of the investment grounds or the investment destinations remains India remains one of the more favorable ones. Having said that, it's important to recognize, and I completely agree with what the gentleman talks about in terms of the infrastructure, because this current phase is in some sense temporary. In some sense, it might last for 2 years, it might last for 6 months. We don't know that. But the point is that if we are not investing in infrastructure, we are not creating capacity. If we are not creating capacity, we are not increasing supply. And if you're not increasing supply, if we are talking about a demographic dividend, etc., we won't be able to cater to that. So in terms of talking about infrastructure, it's bang on. You have to create that, and that is what will push India onto, say, for example, the leagues of, say, a China or a Korea or a Japan. So some amount of technological progress, innovation, and obviously on a more tangible sense, infrastructure development is required.
All right. We have a lot of questions flowing in from Twitter and Facebook too. Mr. Manoj Vasudevan here, he wants to know what is your outlook on the real estate industry and for the upmarket as well as the budget housing segment?
This is where I think I take a step back and I let my colleague come that. So I will refrain from speaking on how the real estate sector looks. What I will make a point on is that there is an adequate, obviously, when we are talking about housing for all and budget housing, there is adequate focus from the government's part. So it is best to remain optimistic, given that the government is seriously looking at, and it's one of the key themes of the government. So if I were to look at themes, urban development, rural development, roads, transport, etc., seem to be railways, defense, seem to be the more favored themes in certain sense for the government, which I think gels well with the budget housing part. Real estate sector, I think it's not my domain of expertise, and hence I will very sorry, but I'll refrain from answering that.
All right. The next question is from Mr. Manoj Kumar. He wants to know what is the future of oil prices and their impact on India?
I think the future of oil prices, the oil producers also don't know, so I would not hazard that. And what I'll talk about is where we expect it to be. And very honestly, that expectations is just an expectation. It's not an estimate or a forecast or anything. We factor in oil price of around 42 to 45 on an average for FY17. Can push to around 50. But again, the drivers for these oil prices are very complex. There could be geopolitical tensions. There could be, say Saudi and Iran not agreeing to any kind of production freeze or production cuts, etc. And oil prices continue to remain low, say 40 or move back to 35. I think it's best not to predict the oil price, but at least understand, which is, I think, the second part of the question, that what is the impact? I think oil prices going down is unilaterally good for India. It has created gains in terms of the government garnering in higher excise duty, which it has obviously spent in the capital expenditure in terms of the road sector, the railways. It also has translated to a certain degree, obviously not the full extent, given that the government has taken away much of it, to the consumers also. So from that perspective, there has been a fair bit of urban consumer demand, or even in the rural part, in terms of the agri sector, etc., has translated into a higher demand generation, or at least scope for demand generation. But a level more than the level, I think it's the effect on government balance sheet, the consumers' demand, inflation to a great extent. If you're looking at wholesale price inflation, which is what you would see at the wholesale level, those prices have, the inflation has crashed, and that is, I think, significantly important in terms of, not at the retail level, obviously, but as an input to the producers, that these input, the input prices are collapsing or are low. So I think I would just keep it at saying that unilaterally India gains from that. The only drawback is that in the Middle East, and this is what I have talked about earlier, is that if the Middle East countries are the countries where we have a remittance flow coming in, the oil-producing countries, if they do not grow, or they cut back, or they kind of, sorry, I think I've lost. I'm back, I guess. Sorry. Okay. If Middle East countries, etc., do not really, start to cut back, if they start to cut back or not invest as much in construction, etc., you would have a negative effect in terms of one, the remittances. Secondly, another, and this is through the capital account side or the capital flow side. Some of these largest sovereign wealth funds are from the oil-rich companies, oil-rich countries. And if the flows from those countries slow down, or if the sovereign wealth fund is not expanding at the rate it used to, you will have some impact on the capital accounts flow too. So there are some downsides, but I think the upsides for India are much more than the downsides.
All right. So we have a question from Mr. Rahul Kumar. He says, with subdued growth in manufacturing, which is below the real GDP growth, when do you see an effect of Make in India coming in?
Effect of Make in India. Okay, the way I look at Make in India is slightly different from probably what the general consensus might be. I think Make in India is a journey rather than a destination. So in some sense, Make in India you have as a theme, but I don't think there is an end to saying that, okay, we have started making in India. First of all, there are various stages to ultimately reaching as a preferred destination. One is on the taxation front. You need to have transparent taxation policies. Second, you need to have the infrastructure. You need to have land banks. You need to have indigenous machinery, etc., that will be available. And over and above that, in a general atmosphere where manufacturing is competitive in certain sense. I mean, till now, even as wages have gone up, real wages or nominal wages, whichever way you want to look at it, have gone up in China, but still it continues to be the hub of manufacturing. And that is not because cost is the only issue. There are other associated factors. How well the ports are utilized, how well the SEZs are structured, what are the taxation policies in these SEZs, what are in sense the road or the railway network in the country. I think all these matter more than just saying that Make in India is happening in the country. I think these are the inputs that need to go in if Make in India or has to be successful. So for me, it's a continuous journey rather than saying that we'll see effects of Make in India very soon.
All right. Uh, some we have just 10 minutes left into the webinar. We'll have some very quick question and answers in the next 10 minutes. The next question is from Mr. Kunal Nopani. He says, what is the likelihood of a scenario where RBI has to hold back on reducing interest rates due to volatility in exchange rates or capital flows?
Yes, I mean that obviously always remains a threat. I think which Dr. Rajan has obviously highlighted so many times that we are in some sense at the mercy of, say, the G3 central banks, or to a certain extent what China is doing with its own monetary or fiscal policies. So in some sense, yes, we remain hostage to that. But at the same time, the RBI possibly can only look at its own mandate, that how well it is the inflation trajectory panning out. So if the inflation trajectory, and this is how I want to put across, the interest rate part, is that if inflation is coming down, there is case for interest rates to come down. Obviously not at the same pace, but at a pace which at that particular juncture of the economy is suitable. So if volatility is there, obviously you would wait out and possibly pass through the volatility phase. If there's Fed hike coming in with a lot of market volatility, if China is kind of slowing down very rapidly, and there are secondary effects on the Indian economy, then you would obviously take a call accordingly. But having said that, RBI's mandate will possibly and it should be on the domestic factors rather than factors which are not in its own hand. So if inflation is coming down, it makes sense to have interest rates, have lower interest rates. I hope that answers your question, Kunal.
All right. The next question is from Mr. Parmar, Uday Parmar. He says, how do you look at the health of the banking sector after all the pain in December quarter? And do you think things are improving of late?
Banking sector, I think I would put it that I think we are past the trough. This is the phase where you start to consolidate. Obviously, that does not mean that there won't be NPAs coming in. Obviously, recognitions will happen, but at least you reach a trough in a certain sense. This is where the banks start to provision more, and obviously mandated or directed by the regulator. But at least you are past that stage where you continuously come across companies in distress, or you see surprises on the NPA side on the banking sector. So I'll just stop at saying that we are possibly the trough is behind us, and it will be a bit longish journey from here on. But at least you are possibly going to see, the stabilization is in progress.
All right. This question is from Mr. Hasmukh Desai. He says the economy will not improve in 2017. At the most, it will remain flat. What is your view on this?
Flat as in, okay, let me put it in numbers, 7.3 moving to 7.7. For me, I think that is pretty much flat. So I agree with your view that it's not moving anywhere significantly. If you reflect back to what I was talking about in terms of the investment cycle and the private sector coming in and putting in money in the investment cycle, till that happens, I think it's best to assume that we'll see very incremental changes or growth improvements rather than saying that the improvement is across the board and we are seeing a significant uptick in the growth. So I'll agree with you that FY17 is again a kind of sideways movement in terms of the growth levels. Internals, whether they improve or not, I think that is more important to watch out for in FY17. Possibly FY18, some amount of recovery in the investment cycle, possibly it will be better.
All right. The next question is from Mr. M. Shiva Shankarchari. He says, do you think India needs to devalue the rupee? And what is your outlook on the domestic currency?
I am not, again, asking the question, why do we need to devalue the rupee? If it is because to increase export competitiveness, I'm not a big fan of that. I don't advocate devaluing a currency to increase exports, for the simple reason that if you are trying to gain competitiveness, it is important that you gain it through productivity and efficiency gains, technological progress and innovation, which is a long-run process, understood. But having said that, devaluing a currency and getting a short-term benefit is, I don't think, the right way to go about it. If you really look at, say, for example, a favorite example always for people is look at China, how the currency was weak and hence they gained out of it. You also have to recognize that labor was cheap. China had an amazing infrastructure development throughout the last 20 years. They had used the SCZs in a very, very, in some sense, optimal way to gain maximum out of having a production hub. It got integrated into a global value chain. So that is more important rather than saying that devalue the currency and really have export competitiveness out of that. The second part of the question was in terms of where I look at the currency, where I view the currency at. I think the currency, on an average, I always assume a 3 to 4% depreciation on a yearly annual basis, simply based on what, and this is a very simplistic way of thinking, let me put it at that. And it's just in terms of, say, USD INR, if I were to look at the USD INR, a 3 to 4% inflation differential between the two countries, which broadly what I assume that a 3 to 4% depreciation on an annual level should continue, and that guides my base assumptions for the currency, the INR.
All right. We have time only for two more questions today. This question is from Mr. Anil Rajpal. He says, is the GST likely to kick in this year? What is your view on
it? This year, calendar year, definitely not. Fiscal year, if I were to call it a fiscal year in the sense April 1st, 2017, yes, possibly yes. Provided that the legislation is cleared by the current session. Monsoon session, if it goes into the monsoon session, and again, we don't know how the parliament behaves often in terms of the pace of legislation that happens. If that continues to be slow in the the monsoon session, it just takes time because there are other legislation that's pending in terms of states and ratification and GST Council, etc. So it's time consuming. So it's best to get it out of the way as soon as possible and let the other factors start to kick in, states and GST Council. I think April 1st, 2017 is probably the best bet as of now.
All right. So the last question for today is from Muhammad Samiullah. He says, what are the risk factors to the economy in FY17?
Risk factors, one obviously is in terms of the global volatility. In global volatility, I would put China at the top because the knock-on effects on the other emerging Asia countries and the subsequent effect on India is significant. That also indicates some amount of triggers some amount of volatility in capital flows. So I would put China as one of the top risk factors. Fed, I think it's mostly in the price until unless they come in surprise with 3 or 4 hikes. I don't think they will be doing that. But if if that is not happening, I think the Fed is not a very big risk. Geopolitical tensions in terms of and by geopolitical tension I mean its effect on food prices will obviously be one of the key challenges. Domestic, I think the key challenge, and it's an ongoing challenge, is how the investment cycle shapes up, and more importantly, whether the private sector starts to become more confident. If they are not, then there is significant risk in the economy in terms of the growth part. And yeah, I mean, the usual monsoon continues to be a worry. We'll wait and watch on that one.
All right. Thank you so much, Mr. Rakshit. It was a very, very exhaustive session. And also to our esteemed audience, especially those who took part in it very actively. We have not been able to take a whole lot of questions for the dearth of time. We do hope to address them next time. For a link to this webinar and Mr. Rakshit's presentation, do follow us on our pages on Twitter and Facebook. We hope to have you all back next week. Have a great day ahead.
Thank you.